Welcome to The Debate. The financial world is undergoing a profound, if quiet, restructuring. It's a change that's often been dubbed the currency wars of 2025. But I think we should be clear, this isn't a conflict fought with bombs. It's a strategic retreat from risk, driven by pure necessity.
I think that's right, indeed. The material we're exploring makes it very clear that this shift is mandatory. It's born from two really undeniable structural failures. First, you have the Triffin dilemma, the old paradox showing that no single national currency can really remain a stable global reserve without eventually imploding.
Right.
And second, there's the immediate, almost visceral lesson learned from the past few years: financial weaponization, the freezing of central bank assets, and the threat of being cut off from global payment infrastructure like SWIFT.
And so central banks, having learned some incredibly harsh lessons, have developed this sophisticated new toolbox to address these twin pressures. We're calling this the IR4X framework. That's strategic treasury rebalancing, multi-rail payments, local currency trade, and algorithmic hedging. So the core question before us is, I think, critical. Does this new architecture represent a fundamental and sustainable structural shift that genuinely redefines financial sovereignty? Or is it merely a set of temporary technical buffers that protect nations from inevitable USD volatility without fixing the underlying system? I'm here to argue that this shift is foundational.
And I view this through a different lens. While I agree these tools are necessary, a vast improvement over the old self-harm strategies, I maintain they are inherently fragile. They are technical defenses designed to manage symptoms, but they don't solve the deep systemic macroeconomic or geopolitical risks. They buy time, but they don't buy stability.
Well, let's start with the sheer scale of the risk these systems are designed to mitigate. We're talking about real damage here. A 15% currency swing can wipe out an entire year's worth of profit, the EBITDA, for a major emerging market exporter. The old playbook, things like crude rate hikes or capital controls, was always self-destructive. What makes the IR4X framework structural is the quantitative benefit it provides.
I absolutely acknowledge that the old playbook was a form of self-sabotage. I mean, we all saw countries like Turkey practically destroy their domestic growth with brute force rate hikes. And capital controls, well, that just signals economic surrender. So yes, new defenses are necessary. But let's look closer at your definition of the framework. Specifically, could you quickly break down what strategic treasury rebalancing actually looks like in practice? To me, it sounds a little like shifting deck chairs.
It is anything but shifting deck chairs. It's more like a strategic repositioning of the life raft. Previously, emerging markets held vast sums in long-term, low-yield U.S. treasuries. That's the equivalent of locking all your emergency cash in a 5-year certificate of deposit. Strategic treasury rebalancing means rotating those longer-duration assets into highly liquid short-term instruments, creating a cash liquidity buffer. It's moving from savings bonds to the central bank's checking account, so they can inject cash into the market instantly when a crisis hits, without selling their long-term reserves at a loss.
Okay, that makes the process clearer, but it also, I think, underscores my point. This is a defensive repositioning for asymmetry. It's about surviving a shock, not creating a stable new system. And look at the general trend. Nations are doubling their gold holdings to 25% of reserves and reducing their long-duration treasury exposure. That's an admission that the existing global structure is unstable, and they need physical, non-debt assets to survive what they see as a coming fracture. Speed of settlement, though radically improved, does not replace the depth and trust built up over decades in the dollar system.
But let's look at a concrete example of this. This defensive repositioning enabling genuine policy independence. The India case study is crucial here. When the rupee breached 89 per dollar offshore, the Reserve Bank of India, utilizing strategic treasury rotation, quickly injected over $5 billion into the market. They did this through non-deliverable forwards, or NDFs.
And the use of NDFs is highly sophisticated in itself.
Precisely. For the listener who might be unfamiliar, NDFs are unsettled future contracts. They allow the RBI to influence the exchange rate in offshore markets without actually having to hand over physical dollars or, drain their official reserves immediately. The crucial outcome here is that they executed this stabilization maneuver without hiking their domestic interest rates and without sacrificing their 6% growth rate for 2025. That is policy optionality in action. You contrast that with nations that rely on the old playbook, which are now seeing economic contraction.
I can't deny that the RBI executed a beautiful tactical maneuver there. I mean, they threaded the needle perfectly. They avoided the fatal instantaneous self-harm of a brute force rate hike. But this is still sophisticated liquidity management. It's not structural reform of the underlying economy. The success of that NDF operation hinges on two huge variables that, to me, make it fragile. First is the central bank trap risk. I mean, how many emerging market central banks genuinely have the expertise and the credibility to manage offshore NDFs at that scale without accumulating huge hidden losses or eroding market trust? If a less credible central bank tries this, it could backfire spectacularly.
But that's an argument against competence, isn't it? Not against the efficacy of the tool itself. The system enables policy independence.
It enables independence for the elite central banks, perhaps. Secondly, and I think more importantly, this defense is entirely contingent on the central bank not facing a sustained, massive capital outflow over multiple quarters. The USD system, for all its flaws, has the unparalleled depth and scale to absorb those kinds of sustained shocks. These highly technical bilateral arrangements simply do not possess that kind of structural resilience when facing a true crisis. And speaking of bilateral arrangements, let's pivot to the second contention: the efficacy of the multi-rail systems in local currency trade. You pointed out the incredible efficiency gains, and the 7-second settlement time for mBridge is astonishing compared to the old 2 or 3 day process, I'll grant you that. But efficiency creates its own vulnerabilities to geopolitics.
How so? I mean, the efficiency is pure economic utility.
Well, it becomes a weapon. We saw how quickly geopolitical pressure forced a pivot back in 2022. The ability for Russia to continue its trade relied heavily on partners like China and India being willing to use alternative rails, SIPs, or bilateral LCT arrangements. If the world truly splinters, as the material suggests is a real possibility, these bilateral deals stop being about optimization and start being about enforced alignment. If a neutral trading partner has to choose between maintaining access to the USD bloc or participating in the alternative LCT framework, that increases overall systemic risk for global trade by forcing these impossible zero-sum choices.
See, I'm not convinced by that line of reasoning because the incentives are just too powerful and the messaging is intentionally neutral. India, for example, is very careful to frame its LCT agreements, say with the UAE or Indonesia, not as some ideological stance against the dollar, but as bilateral optimization. It's for sheer cost reduction and convenience. And this cost reduction is massive.
And what were the numbers on that again?
Well, consider the elimination of the 4% conversion tax. Every single time a transaction has to be converted from, say, Indian rupee to dollar, then to dirham, 4% of that value is just lost to friction, to fees, to currency spread. LCT simply eliminates the dollar intermediary. I mean, think about that. 4% straight onto the margin. For key trade corridors like the India-Gulf corridor, that saves hundreds of millions annually. That economic impact is compounding, and it drives adoption regardless of political alignment. It's very hard to ignore free money.
I agree, the economic pull is immense, but political reality often overrides economic logic.
And furthermore, corporate behavior is cementing the shift from the bottom up. We are now seeing major importers, especially those in developing Asia, leveraging their purchasing power to negotiate specific settlement terms. They're saying things like, we will only settle via mBridge, or this contract must be 60% local currency and 40% your currency. This means adoption is being driven by commercial reality, not just central bank mandates. It's pulling these systems out of the theoretical realm and into daily commerce. And that commercial reality brings us to our final area of contention, corporate preparedness and the future of hedging. The shift from a reactive paradigm where firms scramble after a shock to a predictive paradigm, leveraging AI for algorithmic hedging and multi-currency invoicing, is, I believe, the ultimate validation of the IR4X structure.
That does sound impressive on its face.
It is. The firms implementing these advanced treasury functions are slashing their FX losses from a damaging 1.5% of revenue down to as low as 0.3%. They are achieving what the material calls strategic insulation. This proves that currency volatility, which was previously an existential threat, can now be treated as business as usual operational risk. It's just something that can be managed and minimized. This, to me, is the definition of a structural shift in how finance operates.
That's a compelling argument, I admit, but for the very small segment of firms that have the resources, the technical staff, and sophistication to implement these predictive systems. My skepticism hinges on how widespread this adoption truly is. The source notes starkly that most corporates still haven't adopted it.
But the incentive is there for them.
The incentive is there, yes, but the capacity is not. And the global economy's resilience depends on the average firm, not the top 1 percentile. This disparity creates two tiers: the small, predictive elite that are insulated and thriving, and then the massive segment of reactive firms that remain exposed to these massive swings. We saw $22.7 billion in reported FX losses by Fortune 2000 companies in a single quarter when they were relying on the old brittle USD-centric models. If the base of the global trading pyramid remains this fragile, the sophisticated defenses at the apex only save the smartest players. They do not stabilize the overall structure against the next crisis. The system remains unstable for the majority.
I would argue that once this competitive advantage, reducing FX losses by 80%, becomes the industry standard, the adoption curve for the rest of the market will steepen drastically. This isn't theoretical. The business case is overwhelming. The structure is built. The market simply needs to run onto the platform.
But running onto that platform takes time and investment and expertise that many firms simply don't have. Until the majority of global trade is hedged and flowing through these multi-rail systems, the entire global financial system remains fundamentally exposed to the risks of a system that was designed 80 years ago.
So to sum up my view, the structural change is happening now. It's driven by necessity and enabled by technology. The IR4X framework offers central bankers a philosophical leap forward. They no longer have to choose between maintaining policy independence and sacrificing growth. They can opt for strategic positioning in structural reform, securing a future of financial optionality, as the material suggests. The framework redefines what financial sovereignty means in the 21st century.
And my skepticism, I think, hinges on a separate issue. While these solutions are technically ingenious and absolutely necessary, they introduce new, complex risks. The geopolitical fragmentation we discussed, the fragility inherent in the CBDC trap, and the highly technical central bank trap risk. The dollar's unparalleled depth, trust, and its network effect are not easily or quickly replaced by a patchwork of bilateral and multi-rail solutions. So for me, these advanced defenses are essential for nations to survive volatility, yes, but they are insufficient to guarantee systemic stability against the next truly massive capital shock.
The real currency war of 2025 is quiet and technical. It's being fought through thousands of calculated decisions made by technocrats and CFOs trying to save their national balance sheets and corporate margins.
And the essential question for the listener remains whether these sophisticated actions will ultimately lead to a cooperative convergence around a stable multi-currency system, or if they are simply preparations for the financial Cold War that the source material clearly warns us is already unfolding.